Today we're diving into a very powerful ICT concept, catching reversals in an uptrend. I'll walk you through a recent trade where I spotted a key level to frame a reversal using just pure price action, not relying on any lagging indicators. We're reading the charts to understand what's really happening behind the scenes. This is such an instrumental tool for your trading arsenal, and I am excited to break down this trade for you guys today. All we ask for is a like and subscribe to help the algorithm. We're dropping free gems and you don't want to miss out on any of it. Learning how to trade does not have to be hard. Remember, the right information will lead you to the right outcomes. So help us out. We're on a mission to get the right information to the right people. And if you're just discovering us, hit that like and subscribe button. We're going to be doing big things and growing this community, and you're not going to want to miss out on it. Apply and challenge yourself, and I promise you will be rewarded. These exact trades can be learned by anybody who is willing to put in the effort and improve. So don't give up on yourself. Watch the video to the very end. So I hope you enjoyed the TED Talk, and with that, we'll send you to the rest of the video. All right. Hope you guys are locked in, ready to learn. To begin, we are on our higher time frame. We are at the 4 hour, and we are looking at what price has done up until this is July 19th. We're right over here. We see that this is where the price, the market has gone on to. Our entry was around this area, around the 600 to 500 zone. So if we held this a couple days ago when we took the trade, we'd be up tremendously if we were a swing trader. Unfortunately, we are not swing traders, but that is all good. We intraday trade, and that's what we like to do, and we'll stick to it for now at least. But anyways, to begin, we have to focus on a few main things, some key things, and that are liquidity pools, fair value gaps, and market structure shifts. Those are the things that we look for when we are about to take a trade, or look for in areas of interest to start wanting to seek a trade. So those are a few things. Let's see if we can mark off those things right here. So on the 4 hour, we've already marked off our all-time highs right over here, and then we marked off our most recent lows. As you can see to the left here, this is a most recent low. This is a liquidity sweep right here. We see that the market was in an uptrend. It swept these lows. It took out its previous low. Let's zoom in right here just so that you can see what I mean. Oops, I moved the line. But you see the market was in a strong uptrend, and then it continued in the next candlestick for 4 hours in an uptrend, and then boom, just like that, it really just swept past the previous candlestick's low, and then wasn't able to close, and then continued to go and create more highs. So that is a liquidity sweep. So that's key to us. We marked that off because the market did that for a reason. It went down to that point and then pushed off to make new highs for a reason. So as we're kind of just looking into everything, we mark off that as our lows, and then we mark off our highs because the market did the same thing on the buy side of this move for a reason as well. What do we see left off though when we come up into this all-time high? When we sweep this high, we go and create a huge candlestick to the bottom. This is a huge candlestick, short candlestick. It just swept all of these lows that we just talked about. It swept a bunch of these down to the bottom side. So that is signaling that a different type of momentum has now come into the market, and this is of course, right, a 4 hour candlestick. So it did this for 4 hours. It took out lows for 4 hours. That means business. The market meant business right there. It meant what it did. It was not an accident. It did this on purpose. So we have to look at that and think to ourselves, why will I now start taking longs after the market just showed me so much of a sign that it wants to continue in a selling program? So that's what's happening right here. Again, this is the 4 hours, so this all looks very like close together, but I assure you it's not. These are several hundred points away. My entry was around this area right here. And the lows, the most recent low, we'll mark it off, is right over here. So the market puts in this low, right? And then afterwards it sweeps and pushes up back into a buy program. Of course, we could have entered and we could have taken longs. Yes, that is one way to trade, right? But this was a different day. As intraday traders, we're not going to be here for 8 hours, right? That's entering swing trader territory, and we don't have time like that. We want to find something that will work for us in the amount of time that we are able to be on the charts. So anyways, going back to what we mentioned, we can mark off a few points of interest. The second thing that we spoke about were fair value gaps. We'll mark off those. We see a big fair value gap right over here. And I like to mark off my fair value gaps as zones. I know other people like to, draw them out as lines. That's one way to do it. This is a way that I personally found success with. Whatever way you try to do it, that's completely okay and fine. Just stick with it and know how to use it. So that is one that we see that the market respected. The market went and created these lows. It stopped for a bit, created new highs, but it was not able to break past this area. This fair value gap was respected. And we can mark this off as well as a higher time frame high. So we'll mark that off, and we see that the market respects it. Anytime we get into this area or even past these certain levels, the market is not able to close. There's no body candlesticks closures above this area. So this will be a point of interest. Even this wick right here, we can talk about that in another video, is a point of interest because the market tries to push into this wicks area and is not able to get past it. But that is a topic for another video. Let's go down a time frame to the 1 hour and see what we find. So as we are on this time frame, the 1 hour, we want to do the exact same thing we did on the 4 hour. We want to identify our liquidity pools, and we want to identify fair value gaps and market structure shifts. We already did the market structure shift right there. So we already have that drawn out, a nice little market structure shift, but that is not toward our bias. We want to continue to look for things that are toward our bias. And that's not to say that we won't mark off these things though, because if the market gives us enough reasons to go against our current bias, then we will go against our current bias. That's just what is more beneficial, to not just stick with a bias and think that is the only way it could go. If enough signs are pointing towards that direction, it gives you enough confluence to change your opinion. You don't want to be stubborn and then get wrecked by the market. If the market is telling you it wants to sell, it wants to sell. Believe it. So next thing we're going to look for are fair value gaps. We see a big fair value gap, right? Off to our left right here. This is very key because we see that the market just finished a sell program. It should be starting a very strong bullish program, because typically what happens after you take out lows, it goes in the opposite direction. It creates new highs, right? So the market pushes up into this fair value gap and is not able to break past it. Typically, if we are going to go for longs, this should be disrespected. This fair value gap right here should be disrespected. We should break past it, and we should break past it with, some solid resolve and start using it as support. We see that the market couldn't even get past the top of this fair value gap. We'll go ahead and delete this one right here so it looks a little bit cleaner. The market is unable to break past the top of this fair value gap, and it is being completely respected. But for some reason, right, even though the market is respecting it, we are still we're still exhibiting a little bit of caution, because what we see happening is the market comes up into this fair value gap and then starts to go down. For some reason, it does not plummet all the way back down and create new lows. For some reason, it stopped right over here at this 510 level. We see the support playing out and it creates newer highs, right? And then sends back lower and is stopped again. But one thing that sticks out is the fact that when we go from these highs, we come back down and we're creating new lows. Every time we come back down, we take out the last low. Last low's taken out, next lows, all of that becomes taken out. So I'm seeing this fair value gap, right? On the 1 hour time frame, this was created. It indeed was created, right? But every time we come back down here, the market seems to disrespect it more and more, taking out previous lows in the process. So that piques my interest. So on the 1 hour time frame, I have this marked out. So I am going to now look to go down to a lower time frame. Now on the 5-minute time frame, we're going to look at the exact same things we looked at before: liquidity pools, fair value gaps, and on top of that, market structure shifts. So where can we see such things taking place? Well, I look over here and I'm going to mark off this fair value gap on the 5-minute. This is going to give me a little bit more context in terms of knowing where to enter, where I might be looking for an entry, right? We see that the market has gone ahead and created a new low over here. After the low is taken, it takes out some highs, right? So I could start to look for shorts right now as well, right? But I want to obviously wait for the right time, because this is now like talking about like London hours, right? So this would not have been even in, you know, our trading times anyways. But we can now look over here, right? When our trading time does begin, here we have 8 a.m., 9 a.m. market opens. What ends up happening? The market takes out this low. It does not come back to this low, right? Before going to take out all of this low resistance liquidity over here. So these are our liquidity pools that we're marking off. Our liquidity pools right here. We see that the market pushes past these highs right here. It pushes past another high that we see over here, and it aims for this most recent liquidity high pool right up here. Now, unfortunately, it becomes a failure swing, right? But we see that we are in this fair value gap, this 5-minute fair value gap. Let me slide this over right quickly. 5-minute fair value gap. Now, I want to go down. Once we get into this fair value gap, I want to go down another time frame, down to the 1 minute, and that is where I will look for my entry. Okay, so on the 1 minute, we have our 5-minute highs right up here. We have a low, right, that the market created down here. I want to mark that off because on the 1 minute, that creates our range, right? So we know that our most recent high is right here. Our most recent low is down here. We're going to be playing this range. So I want to pull out my fibs and I want to mark off where discount is. So I'm aiming for the lows down here. Discount is anything above 50%, right? So we have our 23.6 and our 38.2. Nothing beats 0% though for discount, right? So I'm gonna bring that along here as we go into this range, right? And as soon as price comes into this fair value gap, I should see, let me zoom in here. I should see the market totally disrespecting this fair value gap. I should see the market disrespecting this 5-minute fair value gap. Is that what I'm seeing? No, it's not. I see the market try to poke up past the fair value gap and fail to take out this high. That tells me weakness is in the market. I also time this with something that's called an SMT, which is the diversions in the market. We can talk about that in another video, but that tells me that there is a deviation between other indices. The NQ and ES had SMT around this area. So price is not able to close above this fair value gap. It in fact swings all the way down, swings low, signaling that we want to now have a shift in momentum. We take out lows, we take out other lows down here. On the 30-second, we could probably find some more lows being taken out. We see price come back up into this fair value gap, but is not able to close above 50% of this range. We'll mark this off. 50% of the fair value gap is over here. This tells me that there's weakness right here in the market. We're not able to close above this range. So I am now looking, my eyes are peered and peaked for an entry. I take an entry from right over here off of this fair value gap. Fair value gaps are the best places to enter in on an entry, and we are in the middle of two fair value gaps. Seeing that price is not able to again come back into this 1 hour fair value gap, we see that there's going to be weakness here, and I see that we are on the other side of this range. We are in discount of this range over here, so that signals a good entry. And if you were able to take that entry, you would be able to aim for the lows, most recent lows, giving you from 675 all the way to 506. We're talking about over 160 points right there on that move, and that is how you spot a reversal like that. A great reversal trade. Take it high into discount, right? Discount of the range, find a fair value gap that meets up in discount of the range and overlaps with another fair value gap, and take it to the other side of the range. Also, we saw price ram through a lot of liquidity pools right over here. We see that price push past all of this low resistance liquidity. Typically after it takes out a bunch of liquidity, we send in the opposite direction, and that is how you frame reversals. Hope you guys enjoyed the video and got a lot out of it. If you want to watch me trade these concepts live, you're going to want to watch these videos right over here. And with that, we'll end the video and see you guys in the next one.